Hello and welcome to our discussion on the preparation of financial statement. This is Professor Ramana. In this session we will try to understand how the financial statements are prepared, particularly when we want to prepare the financial statements for every quarter. So let me take you through an example. So we are saying that financial statements for quarter 1, and that is the first year when the business was started. So financial statement for the first quarter. And these are the transactions, which are very normal transactions that we have been seeing. So they started business with capital. Okay, so capital, I'm going to show 100,000, and there is a receipt. Okay, so there is a receipt of capital 100,000, and but at the same time one of the partners gave a laptop as capital, so therefore they have not received the cash, but they have received an asset called laptop, and the cost of that is 20,000. So the capital will go up by 20,000. So capital has been contributed in the form of cash and in the form of the laptop. And they availed a loan. Okay, so there is a loan. They have taken a loan of 100,000 once again, and the loan is a source. Okay, so the loan is a source. I show the loan on the sources side. Purchase stock for cash, so therefore I'm going to make the payment for the purchase of stock, and purchase stock is how much? 25,000. And on this date stock is an asset, so I show the stock as an asset. Many times people would like to know why I'm not showing that as an expense, because on this date it is an asset, so there is no question of showing that as an expense. But then once again I purchase some more stock, and this time I purchase it on a credit. So I'm purchasing the stock on credit from Mr. X, that is 50,000, and stock will go up by another 50,000. Okay, in the first case I made the payment, cash outflow. In the second case I purchased on credit, so there is a creditor. Then you are purchasing plant for cash, so I make a payment for the plant, that is 65,000, and plant is an asset, 65,000. Okay, and depreciation on the laptop, and we can also put depreciation on the plant. Okay, so that to consistency sake I'm using 25% per annum, and depreciation is an expense. Okay, depreciation on plant is an expense, and depreciation on laptop is an expense. But you have to be careful, this is for the quarter, so 25% into 60,000 divided by 4 for the quarter. Okay, so divided by 4. In the same way, 25%, okay, 25% into laptop, 20,000 divided by 4. Okay, so we have this. As a result, by the end of the quarter, the value of laptop will reduce by this much, value of the plant will also reduce to the extent of the depreciation, and depreciation there is no cash outflow. Then you purchase, you paid an expenses. Okay, there are expenses, but it did not pay that. Okay, so therefore expenses for the period, because of accrual concept I have to show that, but I have not paid expenses, so therefore I make it 0. But since I have not paid expenses, I have to show outstanding expenses as a liability. 20,000 minus 0 is an liability. And now you see we are selling the entire stock, so that is an income for us, and 100,000, and you got cash. Okay, so sales is 100,000, and whenever there is a sales there has to be cost of goods sold. How much you sold? you had a stock of 75,000. So on this date we can say stock available, okay, stock available was 75,000. Okay, so it's easy for me to calculate, that's why I've shown that. So into 75,000 0.3.75, how much? I'm 50%, okay, 0.50, okay, so 37,500. 37,500. So maybe I can remove this so that it'll get confusion. So all other items have been recorded except the interest, and interest is due to accrual concept. I show the interest at the rate of 12% per annum. Okay, so once again I'm going to show that for the quarter. Okay, so by 4, so 3,000, and interest is paid annually, so I'm not going to show interest as a payment. Okay, so 0, so there will be an outstanding interest, that is 3,000 minus the payment, that is okay. Now all the transactions are done, so I have to find the expenses and incomes. So therefore I'll get the profit. So the total expenses for the period, okay, total expenses for the period is 68,000. So profit, I'm ignoring the tax for the time being, so profit is 34,000, and that profit I'm going to show that as a for the period. I'm not using that profit or distributing the profit, so I show the profit in the balance sheet as a retained profit. That means I'm retaining that in the business. So income statement is done. Income statement is done. Similarly, I have to find the cash flow, cash in hand, and cash in hand is a cash receipt minus the cash payment, cash receipts minus cash payment. So cash in hand is equal to 300,000 minus 90,000, and cash in hand is an asset. Cash in hand is an asset, 210,000. So if all other things are right, then I'm going to have the balance sheet total will be same. Okay, the assets should be equal to the liabilities, or the assets should be equal to the expenses, but unfortunately we are not able to get here. Let us see what did we miss. Okay, so cash in hand 200,000, retained profit I kept here, outstanding interest, laptop I've reduced that. Maybe let us do that once again. Formula, so interest has come down, laptop has depreciated, okay, the stock has to come down because I've reduced the stock to the extent of 37,000. Okay, so my balance sheet has to tally, and it has tallied. Okay, so you should be careful that all the items are recorded the moment the transactions are entered into. So the quarter, at the end of the quarter, your balance sheet will have the retained profit for the quarter, and the income statement will show incomes for the quarter, the cash and expenses for the quarter. The cash flow statement will show the receipts and payments for the quarter. So therefore, at the end of the quarter, the business or the financial statement will show the profit for the quarter and cash in hand for the quarter at the end of the quarter, and the balance sheet will show the sources and assets by the end as on the date of the Q1 end. Now if I take it forward, I say that this is the sources of and the corresponding assets at the beginning of, okay, at the beginning of the second quarter. Okay, so therefore let me paste special, or maybe I'll try to copy that. So I'll say the sources and the assets are at the end of the Q1. Okay, so let me pull it down. And the sources and the assets as on the opening balance sheet for the Q2 will look like this. We'll format it later. So that means I'm having at the beginning of the next quarter, I'm having assets and corresponding sources like this. So an existing business will have an opening balance sheet. Let us rush now. And during the year, once again, I purchase some stock. Okay, so therefore opening cash in hand was there. I purchased the stock for cash, so I say stock purchase is 50,000 and I paid for that. So my stock will go up. My stock will go up by 50,000 and sold entire stock on credit. How much stock you have? So I'm going to sell the entire stock for credit is 175,000. I'm selling the stock, entire stock on credit for 175,000. So sales, there is no cash, so therefore you're going to have an asset. Okay, you're going to have an asset called receivable or debtors. What is that? Sales minus the receipt. So okay, I should put it here on in the second quarter. And expenses for the quarter, once again I forgot to put the cost of goods sold, and the cost of goods sold is 87,500. So therefore entire stock will vanish now because you sold the entire stock. Then okay, let me see whether we are doing right. Yes. And expenses for the quarter, is 20,000, but you did not pay that. So expenses we did not pay, so outstanding expenses will increase by 20,000 and you did not pay, so it will become 40,000. Interest, once again an expense, so I'm going to show interest. We saw the last time how much was the interest for the quarter. Interest for the quarter was 3,000. Let me show that as 3,000 once again, but I don't pay the interest, but I show that just for our clarity. So outstanding interest will be at the end will be 3,000 plus 3,000 minus 3,000, so that will give you outstanding interest. You purchase stock once again on credit. My stock will increase by 20,000 or 80,000, and there will be a creditor. Okay, so I put Mr. X as a creditor. Last time I purchased, maybe let me put another item called creditor. Okay, creditor. I'm purchasing the goods on credit. Okay, so once again we have depreciation on plant, and depreciation on plant also 25%. So depreciation on plant, depreciation on laptop, which is same as what we did in the last quarter. Depreciation on plant and depreciation on the laptop. Okay, so depreciation on the laptop is shown, but you have to be careful. Depreciation will reduce the laptop value. The depreciation will reduce the plant value to that extent. Okay, so depreciation, maybe I made a mistake there. So the depreciation on laptop will reduce by 1250, and depreciation on plant will reduce by 4,000. Okay, so we have done with depreciation, we are done with interest. So let us find the profit for the quarter, and the profit for the quarter is 11 expenses, and this is income. So let me copy that. Okay, and so as a result, profit is equal to 175 minus this, and What will I do with the profit? The profit, unless mentioned, so I'm going to show that as a retained profit because I'm not distributing that. So retained profit, and there is no cash outflow, there is other than the stock purchase. So therefore cash in hand is equal to 210 minus 50. So cash in hand will be 160,000. There is no change in the capital, there is no change in the loan, there is no change in Mr. X. If we are not wrong, once again we will have the assets side will be equal to the sources side, which is asset side is equal to the sources side. Okay, so that means by the end of the quarter 2, the balance sheet of there will be a balance sheet for every quarter end, and the income statement for the quarter. The income statement and incomes and expenses are for the period. The cash flows are during the period, and the balance sheet is as on that date. That means it's a cumulative picture. Balance sheet is as on that date. So if you're able to see this, that means the business is retaining the profit of every quarter and is not distributing. Maybe they'll distribute at the end of this third quarter or the end of the fourth quarter. So the business model keeps on moving. So the last quarter's balance sheet will become the opening quarter's balance sheet. Now I can copy this and say this will be the opening balance sheet of the Q3. Okay, this is the opening balance sheet of Q3. So let me copy that, but later on we'll do it. So opening balance sheet of Q3 will look like this. So that means the business keeps on accumulating, and okay, I should have shown at the end of the okay, so this is the balance sheet at the end of the Q1. This was the balance sheet at the end of the Q1. Okay, so Q2, then it's a Q3. Okay, so and Q3's income statement will once again be prepared on the basis of the expenses and incomes. So what I will try to do now, let me recap. So in the Q1 you had this transactions, Q1's balance sheet, Q1's income statement, Q1's cash flow. In Q2, the balance sheet of the closing balance sheet of Q1 will become the opening balance sheet of Q2. Okay, so therefore by the end of the Q2 you're going to have the new items because of the transactions, and the transactions are visible on the Q1 and Q2's income statement and cash flow statement. In the later session we'll try to see what will happen in Q3 and Q4. Thank you very much.